On our next panel, our speakers will share their thoughts on private market capital deployment in the current environment and where they think present the most compelling risk-return opportunities. So now let's welcome our moderator, Shen from HongShan, and our panelists, Bei from KKR, Jim Coulter from TPG, Rob Lucas from CVC, Howard Marks from Oaktree, and Harvey Schwartz from Carlyle. Thank you. Neil, over to you.
Thank you. Thanks, HKMA, for inviting me, and it's my great honor to moderate this session. We got 5 heavyweights in the private markets. I guess private markets really play a very, very important role, as Mark was, alluding to in the early session, that oftentimes was feel it's more risky than the public market, but it turned out to be safer and creating better returns. So let's start from Howard. You has wrote letters all the time, and one thing you have mentioned about the sea change that you mentioned 2 years ago, highlight that a substantial portion of the investor return over the last 40 years because of lower interest rate environment. And the year ahead won't be that easy. So can you share a bit on that particular note, like given the rising asset price and the declining cost of capital, before for the private equity, and now, what are we gonna expecting to see in the future?
Thank you, and thank you for giving me the opportunity to be here today and on this great panel. In the memo, I said that in 1980, I had a bank loan outstanding personally, and I got a slip of paper in the mail which said the rate on your loan is now 22.25. And 40 years later, in 2020, I was able to borrow at 2.25. Now, I hope I became a better credit, but I think that was a very, very important factor in the history of the world. In fact, I think it was the most important single event in the financial world in the last half century. Now, it took a long time and it was gradual, so it might have gone unnoticed, but very important. And so that's number one. And of course, declining interest rates make, among other things, make assets more valuable and make the cost of borrowing less. So that leads to number 2, which is that something we call the leveraged finance industry was invented in that period. And private equity and of course the growth of real estate and other leverage strategies. And of course, the beneficial effects on the value of assets and the cost of carry were very helpful to those industries. And they got traction, and of course private equity, which my co-panelists are the leaders in, have been described as the silver bullet in the last 5 or 10 years for any pension fund which is underfunded. So that's very, very significant. And then of course, in the 09 to 21 period, we had the lowest interest rates in history. The Fed funds rate was 0 most of the time and averaged 0.5%. And that was a great time. Now that brings us up to date, almost. But in that period, when credit is readily available and almost free, what's the smart thing to do? Leverage up as much as possible. And a lot of people did. Now, of course, things have changed. We had a bout of inflation that required the Fed funds rate to be raised from 0 to 5.25, 5.5. And many investments were saddled with capital structures that didn't anticipate a 500 basis point increase in rates. And they'll have to go, some have adjusted, some more will have to go through a period of adjustment as we get maturities, et cetera. But I think the important thing is that when leverage is not as cheap and not as readily available, the ability to produce returns will come from being able to buy things well and add value, not from merely buying, levering, and enjoying an increase in multiples. So this is a lot of what our industry has to do ahead. In this period, I think what I would say is beta will not be enough, market trends. It'll take alpha, personal skill. I think that, I'm sure Mark is right that, private credit has gone from about 250 billion in '07 to about $1.5 trillion today. So 6x in 17 years is a hell of a growth rate. I'm sure it'll keep growing, but we all know that in that period the tide didn't go out, to paraphrase Buffett. We didn't find out who's naked, and one of these days we will. So I'm just trying to set the scene, and I look forward to hear what everybody has to say about this environment.
Great. So have to buy well and seeking alpha. Harvey, so you have a Washington roots, Carlyle. So how you look at it, interest rate environment, and how you look at it, the potential impact on that front with Trump 2.0?
Yeah, well, first of all, it's great to be here, Neil. Thank you, and congratulations to the HKMA on a fantastic event. It's an honor to be here. So before I get involved, I want everybody to know Howard and I are friends. And he just gave a very good description of economic history, and I wouldn't debate that with Howard. But what I would say is over that period from 1980 to today, the first part of that decline in interest rates, which he did highlight very explicitly to 2009, I think that was really driven more by monetary policy, globalization, increases in technology, efficiencies in capital markets, and basically everything that drove deflation over that period. From 2009 to today, that excessive period of monetary policy was really in response to 2009. And of course, I think we'll look back on economic history and we'll see that it was really unfortunate that the financial crisis happened in 2009 and the pandemic followed pretty quickly after, because it doubled down on fiscal spending and support, and it also doubled down on monetary policy. And then of course we had the reaction we had. I think that in any investing activity, one has to be in a position of micro asset investing. You have to have a value creation plan. And the way we think about private markets, we're $450 billion at Carlyle today. The largest segment, by the way, is credit and insurance because of the growth in that market. When we think about private markets, and when you look at private markets, very little about the evolution of private markets has to do with the decline in interest rates. It has to do with the ecosystem of finance. We didn't have ETFs. You heard on the earlier panel, it used to cost, I don't know what Pong said, $100 to trade a share of stock or several shares of stock. This has been an advancement that's happened from the 90s. I don't think the Wilshire 5000, Howard, you probably know, has had 5,000 names in the Wilshire 5000 in a very long time. We've actually lost half the public companies. That's not because we made a rule that public companies shouldn't exist. Companies figured out that private capital would allow them to grow more efficiently. And so I think private capital has played that role. In terms of interest rates, and I think I'm the first person that's been asked explicitly about Trump, but this is what I'll say. With respect to interest rates, when we look at our portfolio companies, which cover more than 1 million people around the world, the economy generally looks good. It looks particularly good in the US. And the data supports everything you're seeing in the numbers. A year ago today, if I was here, I would have told you we thought based on the KPIs we roll up, we would have seen 2 or 3 interest rate cuts. I think now we actually don't see a number of interest rate cuts. Last year, the market was calling for 6 or 7. We may see a handful next year, depending on how things evolve. But all the policies we know Trump will put in place, lower taxes, more spending, less regulation, those are all pro-growth. And you're seeing it. So I would expect interest rates to stay higher. But the key point I think Howard raised is a market clearing cost of capital is better for everyone.
Great. So Joe, with this new changing dynamics, right? And we all know that we just cannot rely on multiple expansion to creating return. So what are the playbook for private credit investors, specifically KKR? What are the strategies you're adopting to creating, the good return for the investors?
Well, first, let me thank you, HKMA, for this incredible event. It's great to be back here in Hong Kong. I think Howard said it well. This is about buying well, but more importantly, creating alpha, operational value creation in the companies that you fundamentally buy. I think in our industry, it's a very competitive industry. If you look at this panel here, everyone's constantly trying to evolve and increase their competitive advantage in the marketplace. So how do we do that in private equity? First of all, it's around capabilities. So it's not just about having really smart deal teams. It's about industry specialization, fundamentally. It's about being focused on the right thematics to win long-term tailwinds. It's about creating other parts of your firm's specialized capabilities, government affairs, public policy, especially in a market like this where regulation, tariffs could be an incredible source of risk or opportunity. It's about having operational executives and specialists on your team. We have an in-house consulting firm called Capstone with over 100 executives working with our portfolio companies every single day. We have an in-house capital markets team. You know, when you think there's going to be volatility in the financing markets or access to capital, we have a 100-person capital markets team. In the last 5 years, they've been underwriters or arrangers of over $850 billion of debt and equity transactions. 2/3 of that is for our own portfolio. 1/3 of that is for third-party clients of ours. So you need a lot of different tools to win in today's private equity world.
Great. So to Jim, so we already talked a bit about how the opportunities present themselves to the private equity investors. But given the evolving regulatory changes and potentially macroeconomic disruptions, what do you think about the sector itself, private equity as an industry? What are the structural changes that the industry could actually evolve into?
I'm a student of industries, and actually one of the most interesting industries I'm involved in is our own. So 40 years ago, a few of us got together in these small partnerships to launch something that didn't have a name. It wasn't named until 1997. Today, that is a $6 trillion industry. And the dollars really don't capture it. If you look, just to use US numbers for a moment, about 7% of the US employment base is in private equity. There's 4,800 public companies in the US. There's 30,000 companies, some of the most interesting companies in the private equity market. And the private equity market is the largest client for banks, law firms, consulting firms around the world because it's an industry that remakes itself every 5 years. So interestingly enough, one of the most fascinating investments you could have made in the last 30 years is the private equity industry. But it hasn't been uninterrupted. There have been moments where things have gone to hell, and there was 89, 90, there was 2000, there was 2008, and in those moments, two things happened. The industry themselves changed the structure, and something good came out of it. Out of the 1990 disruption, the private real estate business came out. The software investing business came out of 2000. The private credit business came out of the global financial crisis. So good things happen, but also change happens. We are in one of those moments right now. Fundamental shifts happening. What am I seeing? First of all, the strong are getting stronger. I'm happy to say you can see it in our stock price, but for the first time, I think people are understanding this industry is hard. I went gray at 35. Like it's not hard to make investments, it's hard to make them over 30 years consistently, and places like HKMA need us to do it for 30 years consistently, and that takes a staying power. In this cycle, John, you know this, more dollars have gone to the top firms in this cycle. There's also going to be a shakeout. Bloomberg recently reported that 25% of private equity funds haven't raised money since 2015. It's hard to kill a private equity fund. They stick around for a long period of time, but the industry is remaking itself. And with capital tight in the institutional marketplace, private equity will find new sources. And what's happening is insurance is a form of savings going into private equity and private credit. We're now going to the high net worth channels. So the industry is fundamentally shifting in some funny ways. And there's going to be some problems to solve. The venture capital industry has a huge NAV problem right now. It's only returning 5% on NAV. It's usually 25%. Obviously, we've got to get DPI flowing in our industry. So fascinatingly enough, one of the most interesting sets of opportunities I see are very close to home. And keep an eye on the private equity industry. One thing that people tend to do wrong is this is when they step back from the industry. The industry was declared dead in '89. It was declared dead in 2000. I remember in 2009, my then 12-year-old daughter walked in and said, Daddy, are you okay? I had the Wall Street Journal in front of me, and the headline was, private equity is dead meat. That was 2008, before a huge growth in the industry. So this is a moment of time where there will be a change in the industry, but as Joe is saying, the tools of the industry mean that interesting times are also ahead.
Great. So private equity is definitely not dead. Actually, Rob, congratulations to you. We just saw the successful IPO of CVC. So how you look at, the sort of this listing considerations as a private equity manager, and how that listing going to be contribute to your long-term success?
Well, first of all, thank you very much to Eddie, to Howard, and the HKMA team for inviting us all over. It's a privilege to be here. No, thank you. It's exciting times, and I think compared to all my colleagues on the stage here, we of course took a lot longer to take the plunge into the public markets, and so we certainly had plenty of time to give it consideration. I think the key for us was actually ensuring that in going public, we didn't lose the very ingredients that were the source of our success. And I would particularly point to two areas. Firstly, having the delivery of sustainable outperformance for our LPs as our key priority. I think that's always how we've built CVC, and making sure that that absolutely remains the preeminent element of our business is key. The second one actually is about culture, interestingly. Just before David was on earlier on, but I asked one of his very senior colleagues to join us at our offsite over in Athens earlier in the year to talk to us ahead of our IPO about what were the main things that Goldman had found were challenges about being public. And he actually said culture and communication. So I don't know whether my colleagues on the stage here would agree with that, but certainly that and maintaining our culture, because the culture is the glue that holds CVC together. Our business is based on a huge international network, 30 offices across 5 continents, and making sure that all of those people communicate, they work well, the relationships and the culture that binds everyone together remains. So those were the key considerations, Neil, that we had. In terms of how it is likely, and we hope it contributes to the ongoing success of CVC, well, it's exactly as Jim's just been mentioning. We're seeing huge changes within our marketplace, all of us. And we're seeing huge consolidation, actually. What we are seeing, as Jim's just said, is the strong getting stronger and the weak struggling. And certainly in terms of the largest and most sophisticated LPs, they are consolidating their relationships and their investment across our industry. They are looking to place much larger amounts of capital with fewer GPs, and they are looking at those GPs with whom they have the deepest, broadest, and longest relationships, and who have delivered for them for the longest period of time. And so that is a key theme. The other key theme, of course, is consolidation amongst the private markets players. And that's a very, very important part in terms of us all growing and broadening our strategies and our platforms. And so being public, I do really feel, gives us longevity. We're in a very, very long-term business. It's about structure and governance, but it gives us the strength of balance sheet and the strength of brand to allow us to build our business in terms of broadening that platform and participating in that consolidation. And of course, we are all ultimately people businesses, and it allows us to continue to attract and retain the very highest quality people. Those would be the key elements, I think.
Great. And European private equity has shown some very significant resilience. So in your view, what are the great opportunities that are out there for you? How you read the market, opportunity for European private?
Yeah, well, of course, Europe is our heartland, and Europe has, as you say, been remarkably resilient over a very, very extended period in terms of delivering private equity returns. In terms of the dynamics of the market, I think it's the ability in that resilience is very largely linked to the dynamics within the market. And those dynamics are very much about complexity. I mean, it was interesting hearing Jean talking earlier on about the challenges that Europe confronts. Europe is an ever-changing dynamic, and it's very, very hard to predict. And I think that is the essence of Europe. Different countries, different regions are facing different dynamics at any given time. And that is why it creates both complexity, but also it creates a lot of inefficiency in the market. I think certainly compared to the US, the private equity market in Europe is a lot less efficient. And of course, for those of us in strong positions within that market, particularly with local people on the ground in those markets, what that means is that we have an ability to really outperform, and that's the real key to the dynamics within Europe. Having local people on the ground in the local markets, and then also just in terms of looking at opportunities, it was interesting just hearing the discussion just now about what it takes to succeed in Europe. I would add another element in terms of what it takes to succeed, in terms of in addition to just having local people on the ground in the local markets, it's about actually not trying to sit at the top of the organization and predict where and how the opportunities will arise. It's about being bottom up and actually being able to sit at the investment committee at the top and see where the really interesting aspects come through. And that's the key to the future, I'm sure, within Europe.
Thank you. So, today if we talk about private investment, one cannot just go without mentioning private credit. Indeed, this is a hot market, and this seems to be getting to a stage of golden age. And Howard, I just want to like you to share some thoughts, on this. Where do you see those attractive opportunities within that particular sector? At the same time, we have heard last year's panel, this year's early panel, all talk about some regulators have concern about this market grows so big that creating some instability from a regulatory perspective. So, what do you think about that? Are you concerned?
Well, obviously, as I mentioned, private credit is a big deal now. It wasn't 20 years ago. And as I think Mark mentioned, a lot of its growth grew out of the failings of the banks or the shrinkage of the banks post-GFC. I think that private credit will continue to grow. And by the way, every meeting I go into, people say, let's talk about private credit. And Mark, I always say, let's talk about credit. We're gonna have both, and maybe Mark's right, we're gonna converge. But I think the important thing to notice about private credit is that it is relatively new in its current size and iteration. And as Buffett would say, the tide hasn't gone out. And the tide will go out someday. And we'll find out who was swimming naked. And we'll find out who made good credit decisions or who did not allow enough margin of safety when they made credit decisions. So there'll be some sorting out, as there always is. And then as Jim says, the best will get bigger. Let me just address for 1 minute, Neil, your question about regulation and risk. My own view is that we're not talking about systemic risks like we saw in the global financial crisis. In the global financial crisis, of course, which was underpinned by subprime mortgages, which had never been tested and which turned out to be entirely fallacious. Number one, we saw the disappearance as independent entities of Merrill Lynch, Bear Stearns, Lehman Brothers, AIG, and several others. I think for two main reasons. Number one, because they were hugely levered, which the private credit industry is not. And number two, because they were interconnected. And we, in '08, we coined the phrase counterparty risk, which then became a big deal. And you know, one person's assets was the next person's liabilities, and they could fall like dominoes, and appeared to be in the process of doing so until the process was arrested. I guess we'd say 16 years ago this month. But I don't see that degree of interconnectedness or the degree of leverage. And you know, if some private credit loans turn out to have been mistakes, and some pension funds or sovereign wealth funds lose a little money, I don't think anybody's going to hold the benefit or rush in with a rescue program. So I think that the risks are idiosyncratic, not systemic, and not alarming.
Great. Jim, back to you. So, you know, where do you see are those specific sector that you're excited about? We got 2.6 trillion dry powders now raised over the last several years for private equity, venture capital. I know you're spending time and focusing on ESG, new energy. Tell us, like, what are the sectors that you like to get into?
We're about to prove that it's not about the landing. You know, one of the things that's interesting to me is we have an absolute fascination with landings. When you're flying home, the one time the plane is quiet is when you're about to set down, even though it's safer than when you pull out of your garage. Same thing is true in the financial markets. You know, a great party game is how long you can watch a financial show without someone saying hard landing, soft landing. Always take the under. And having traveled a lot, it's never about the landing the trip. It's where you start and where you end. And I worry that right now in the financial markets, we've had a 4-year debate. I think this is the longest one, Neil, I can ever think of hard landing, soft landing, hard landing, soft landing. But where are we landing? So I'm not a macroeconomics person, so where we're landing is a very different place. I was jet lagged in Mumbai the other day. I thought I woke up in '78. There were missiles in Gaza, there were tanks in Eastern Europe, there were politicians talking about price controls and tariffs. Like, this is a totally different world. We've assumed margins would go up forever, that markets would be global. We are in a different place, and have you packed for it? Eras are often defined by their business battles. We are going into some of the biggest business battles you've ever seen. Yes, AI is big, but who's going to win? This is battle of the titans. Someone is going to lose. Autos, like, you want to get a country upset, talk about their auto industry. We have EVs, we have ICE engines, we have hybrids, we have self-driving cars. We thought it was going to be about existing companies that were remaking the guts of their cars. We thought it might be about Tesla. It may be about battery companies that are just wrapping their batteries in cars, and those are now at 15% the price of an original Tesla. So what about it when EVs are cheap? Streaming, who's going to win that? Data centers, I agree with you, John, but the profit pools are very unclear. These are going to be fascinating. And what it will take to sort that out is not macroeconomics, it's actually investing skills. And what's on the table? Supply chains are 100% on the table today. For 40 years, we've been making them one way, just in time. Now, all of a sudden, as someone said, you know, just in case, we're bringing them back home. We're going to remake them in a few years. We're remaking our whole IT system on AI. We're remaking our whole energy system. We've done all these things before. We've never done them all at once. Huge capital is going to be needed. Huge investment skills are going to be needed. And then just to kind of give you an investor's perspective on the question you asked, you know, sustainability was an evangelical thing that was taken over by, you know, SASB and GFANS and SBTI, et cetera. It's now quietly become a practical thing. And if you cut through the noise to the signal, it's the cheapest form of energy in 85% of the world. Last year, it was $2 trillion of spending in CapEx. Fossil fuels were $1.5 billion. Yes, policy is going to change, but policy changes in healthcare all the time, and we all invest in that. Most of the policy debate appears to be on the Texas-Oklahoma border. India is not so worried about that. So around the world, this is kind of happening, and how we get behind it as investors is going to be critical. So this idea of, you said it, it's going to be about alpha, but if I'm going to invest in something right now, I'm going to invest in investing skills, because this is an era where your alpha is going to come not from risk on, risk off, but which risk?
Great. So one area in the private investment we haven't touched is real estate. So Harvey, what's your take on the market? Because we have seen some significant repricing of the market over the last 2 years, and there are a lot of changing dynamics. There are headwinds on inflation, there's continued easing coming on the interest rate side, and then there's company asking or demanding their employees going back to office. So what's your take? Do you agree with John's comment early, about the sector?
Yeah, so the headline short answer, because it's always bad to stand the last panel between all of you and lunch, but the headline short answer on real estate is we like it. I think for a lot of people in the world that are not really embedded in the market, particularly in the United States, they think of real estate as, do you like office or not? Because that's what's gotten all the attention. And the real important point, which John talked about, is it's not homogeneous. So we've been in real estate for well over 20 years. We have an extraordinary team. They're actually actively raising capital now, so I can't speak a lot about that. But what I will say is this: when you actually begin to bifurcate the market into its component parts, when you look at office, we are not exactly particularly enthusiastic about office right now, broadly speaking. There are certainly very significant opportunities, but right now, if you look at for example, occupancy rates are running 5-6% above historical averages, even during some stress periods of time, and about $1 trillion to $1.5 trillion of real estate exposure, office space exposure, sits on bank balance sheets. That's not a healthcare Surgeon General's warning about that. That's well understood by the banking system, but it's a very slow-moving iceberg that has to be digested. And so when we think about that, sometimes we think, well, maybe the opportunities are more on the debt side of office, and certainly as it relates to people demanding people coming back to work, when you look at the levels of return, it's not as significant in the US as it is in other parts of the world. And I think we have to assume at this stage, until we get different information, that the demographics of office space have just completely changed for an extended period of time. With respect to the rest of it, one of the things that's happened is interest rates went up, which maybe wasn't as well anticipated by all of us as we should, is the benefit to homeowners. So, for example, take my niece, who's a speech therapist on the East Coast. She locked in her mortgage at 2.7%. That asset, that financial asset for her, looks like a lot of financial assets for a lot of consumers in the United States. That is her best asset, other than when her uncle passes away, which hopefully that doesn't materialize anytime soon. So that's a valuable asset for her. But as rates went up, people were very reluctant to move. And of course, they don't have to move as much now because they can work from home. And so you haven't had the residential creation of housing. And so you do have the shortage that John talked about, multifamily, rental housing, and then demographics, which really are the key here in terms of the shortage of housing, construction because of rates being higher. So there's certainly segments we like, whether it's, warehousing, logistics. I think that's all a very bright spot. And with office, we're super selective.
Thank you. So Joe, back in 2005, you are employee number 1 for KKR in Hong Kong or in Asia. Now the firm has expanded to 9 offices in the region. You have close to 70 billion under management here. So how do you see that market evolve? And moving forward, what are the opportunities in Asia, both as a fundraising sort of destination as well as investment destinations?
So it's actually closer to $80 billion in capital now. But, when I moved here in 2005, it was a very early stage for what we did in private equity, which is large cap buyouts. So we had to adapt our strategy. We were doing a lot of growth investing in addition to buyout transactions. So markets like India, Southeast Asia, China was a lot of growth. And that was a change for our firm. So, probably the 3 things that we had to do differently here. Number 1, we made the decision to really localize heavily from day 1. So we have close to 625 people on the ground right now, 9 offices. I have 2 expats on the ground in Asia today. It's all local hires, local executives in each of these offices. The second major decision we had to make was, do we want to raise a regional fund for our different strategies, or do we want to be part of a global fund? And I'm glad we made the harder choice of raising regional funds, first-time funds in this part of the world, because we have more flexibility to allocate capital in this part of the world and actually recruit talent who's super excited to invest in this part of the world. And the third, there are a lot of our peers who are raising country-specific funds or much more narrowly focused funds. We wanted to have a pan-Asian approach from day one. This is a very dynamic part of the world. You need to be able to allocate capital pretty nimbly and flexibly across these different countries. It's not just valuation, but it's macro conditions, it's regulatory conditions. So you're going to flex people and capital into different parts of Asia at different points in the cycle. So, I actually said when we started our business in Asia in 2005 as employee number one, I said at some point in my career at KKR, Asia's going to be as large as the US in private equity. I think that's true when I look out next 15, 20 years, when you think about China, India, ASEAN, and Japan, compared to the US as a single market, there's no reason Asia can't be as big in private
So when that will be cheap? Another 10 years?
Well, if China would go a little faster, I don't know. No, Japan obviously is the big upside surprise. If you said to me, we'd be sitting here in 2024, and outside of the United States, Japan would be the second largest destination for our private equity capital and our real estate investing capital, I bet no one would have made that bet. But it is today. And I said this at our investor day, if you look at our global private equity returns in every single country around the world, our best returns are in Japan in private equity. It's a combination of low valuations, cheap financing, but most importantly, massive, massive operational improvement potential in these companies that we're buying. So, we're still very bullish about this part of the world, and we got a lot of growth ahead of us.
Thanks. Now I'll come down to my last question. In fact, this morning, actually, I asked ChatGPT what are the questions that I should ask in this group of heavyweights. And I've input every single person's name. And I think we are more or less cover all the questions which GPT suggested. But interestingly, GPT didn't ask me to ask him my last question, which is, what is AI's impact on your business? And I would like to each of us to have a very quick answer to that. And obviously, do you invest in AI in addition to how AI impact your business? Maybe from Joe first. Yeah.
Yeah, so we are not early stage tech investors, right? That's just not what we do in terms of seed or venture. So the classic way people probably think about investing in AI, that's not what we do. We're massive investors in data centers, digital infrastructure, things that can be fundamentally driven by AI implementation. I would say based on the other panel we heard today, for us it's really about how do we drive productivity in our companies. We're not looking to AI to say we want a standalone investment in a growth equity bet or a venture bet. We're trying to figure out ways to leverage AI to make our businesses better.
Jim?
Yeah, I'm a little conservative on investing in it because I just remember it was 12 years from the Palm Pilot to the iPhone. Things take a little time, but it's picks and shovels. So at this point, it's going to touch everything, and we're massive investors in clean power through our sustainability, and suddenly AI is all about clean power. Who knew?
Rob?
I would echo the point that Jim made earlier on. I think there are going to be real winners and losers within the AI environment, AI as total. And so, yes, we are very, very interested in AI. We're investing in it heavily, and we are utilizing it across our portfolio. But it is about selecting, certainly in terms of the companies we're investing in, it's looking at the companies that can really benefit from AI, but the ones that actually can be taken out by AI. And really working that question out is going to be key.
Credit investors like us don't have much to do with investing in AI at this time. We do facilities, we have a power infrastructure fund that'll benefit. I'm an old-fashioned investor, and I think real alpha is about thinking of things other people haven't thought of and getting to solutions and what I call second-level thinking. And I'm not convinced yet that a computer can be trained to outthink the other computers. which is what it's going to come down to. So I hope and believe there'll still be room for the people with the best investment insights.
Harvey, last one.
Yeah, from our perspective, and this word came up, use cases came up a lot earlier. I think use cases are key. So we think about how can we invest better, how can we make our portfolio companies operate and improve better, and then how can we run the firm better. And maybe I'll just give people two super quick examples. But when rates went up and Silicon Valley Bank went out of business and the Fed was raising rates, we took all of our interest rate hedges for all of our portfolio companies and we ran them through chat. And that's not particularly innovative. But the thing that was interesting, was we said, how do you want to think? We basically said to chat, please run 10 different scenarios. And for me, embarrassingly, because even if I had chat, I wasn't the kid that was going to do that well in school. But the 10 scenarios came back, and so I said to the team, why those scenarios? And they said, see, that's what we don't know. But just assume Chad has read every finance book in the world. But, people like Howard have been running stress tests and analysis, but I bet if those tools existed, which are pretty rudimentary at this stage, you don't have a Silicon Valley Bank because those scenarios easily get run. So you can really do that. The other thing I'll say, just the other end of the spectrum, we took 50 portfolio companies, CEOs and CTOs to OpenAI last spring for 2 days. And at the end of the 2 days, I said to the group, I said, show of hands, who here thinks they've had some sort of light bulb moment in terms of how to innovate in their company that they otherwise didn't know about before they spent 2 days here with Sam and the team and Brad, and 80% of the hands went up. Now, I don't know, we're tracking all those use cases. I don't know how many of those will be real use cases, but even if it's half or 25%, it's material. And I agree with exactly what Rob said. In some cases, these are businesses that will avoid going out of business, and in some cases, they will just get much, much better. But I think underestimating the influence this will have over the next 5 or 10 years, the opportunities are extraordinary, but if you don't manage to it, I think you probably do it at your peril.
Thank you. We are completely running out of time, but I really appreciate all the time, and insight for this group of panelists. Let's give another round of applause. Thank you.